Imagine turning your paycheck into a mountain of wealth without using any complicated financial tactics like trying to time the market or chasing the next hot stock. It's actually quite the opposite. So today, I'm going to show you the secret that Warren Buffett says that ordinary people can use to explode their savings into millions. You see, Buffett's approach is deceptively simple, but it has been proven to be incredibly effective over time. The strategy is actually called dollar cost averaging. Here's a quote from Warren Buffett himself. If you like spending 6 to 8 hours per week working on investments, then do it. If you don't, then dollar cost average into index funds. So what exactly is dollar cost averaging? Let me explain it this way. Imagine you're buying your favorite fruit, let's say apples, every single month. Some months apples are cheaper, so you can buy more of them with the same amount of money. Other months, they're a bit pricier, so you end up with fewer apples for the same budget. Over time, the cost averages out and you've managed to get a good deal on your apples overall. Dollar cost averaging works in a similar way, but instead of apples, you're buying shares of a company or units of a mutual fund or ETF. Here's how it breaks down. First, you need consistency. You invest a fixed amount of money regularly, no matter what's happening in the stock market. Second, you purchase more when prices are low. When the market's down and stock prices are low, your fixed amount buys more shares. And third, you purchase less when prices are high. So conversely, when the market's up and prices are high, that same amount of budget buys fewer shares. You end up with below average cost because so many of your shares were bought at relatively low prices and so few were bought at high prices. And below average cost leads mathematically to above average returns. In just a second, I'll show a real life scenario of how dollar cost averaging will actually force you to have higher returns in the middle of a declining bear market. But the beauty of DCA is that it doesn't require timing the market or any complex financial strategies. It's about making regular investments over time, which can help reduce the impact of market volatility on your investment portfolio. So as the market goes up and down, your investment has the potential to grow because you're essentially averaging the cost of all your shares. This strategy is perfect for beginners and those looking to invest without constantly worrying about the perfect moment to buy or sell. Warren Buffett suggests it because it leverages the most powerful factor in investing, which is time. With dollar cost averaging, you're not just saving money, you're steadily turning those savings into a potential fortune. So let's take a look at a real world scenario. I actually got this example out of a book that I read called Simple Wealth, Inevitable Wealth, written by Nick Murray that I highly suggest that you read. I will say though, you can usually only get his books on his website though. What we're gonna do is illustrate what happens when someone starts investing when most people would say is the absolute worst time to start investing, at the top of the market, followed by a massive decline. So let's say that you start investing $1,000 a month for 2 years into a fund that represents the market. And we're gonna start investing at the peak price of, let's call it $20 per share. Then over the course of the entire next year, the market tanks by 30%. Then in the second year, the market or the fund eventually makes it back to its previous high of $20, but doesn't continue past our original starting point of $20 per share. So we start in year 0 at $20 per share. At the end of 24 months, we ended at $20. So effectively, the market had no net change or a return of 0%. Now, the most important factor to note has actually nothing to do with the market, but actually with how the investor behaved. The investor was disciplined and continued to invest even in a declining market. As the stock price decreased, the investor was purchasing a higher number of shares with his $1,000 a month. Because of this behavior, his $24,000 that was invested is now worth $28,500, which is about a 19% annualized return. And this was all accomplished in the middle of what most would describe as a terrible market to be investing in. So once you start putting in some time to dollar cost averaging, you'll start to find yourself longing for a massive decline or a bear market so you can start to buy everything up when it's on sale to improve your gains. Another interesting aspect of DCA is that it thrives in volatile markets. The more volatile, the better for the person that is dollar cost averaging. Because the lower the lows are, the cheaper the prices are. The more shares you're able to acquire when everyone else is panic fire selling their portfolios. So, how do we actually put dollar cost averaging to work in our everyday lives? It's actually super easy. You may even already be doing it with your 401k at work. If you're contributing to a 401k consistently with every paycheck, congratulations, you're already using DCA without even knowing it. If you've already maxed out your employer match inside of your 401k, then you can continue to use DCA in an IRA or even a non-qualified account. All you have to do is set up an automatic transfer on the days you get paid, so you're systematically investing each paycheck. Most brokerage accounts will allow you to easily set this up as a recurring deposit. I personally like to use an app called Betterment to make it super easy to open up an account and then start investing. I'll leave a link for it in the description though. And now that you have that recurring investment set up, you might be thinking, well, what in the world should I buy? Let me start by saying this. How you select your funds isn't nearly as important as you think it is. Nobody is ever going to achieve wealth or fail to achieve wealth because of the particular funds you own. Picking better funds can definitely cause you to be wealthier, but picking the right funds will never be the make or break issue of financial independence. Investor behavior is vastly more important than the ability to pick the right funds. If you're constantly moving your money around in the hottest fund that year and then selling it out when it eventually declines, you not only lose a bunch of money, but you may even drop below your initial investment value. What I can tell you is that I personally love to stick to ETFs due to their instant diversification, and I also try to stay away from things like bonds and CDs. Because if you think about it, bonds and CDs basically don't have any real return on them. For example, if a bond is paying 5% and inflation is 3%, and you're paying taxes on those gains, there's basically not a whole lot left over. If you really want to maximize your gains and have someone in your corner, I would advise using a trusted financial advisor who will hopefully talk you out of doing something really dumb and to just tell you to keep on using the power of dollar cost averaging, especially in a declining market. If you like this video, be sure to check out my other video right over here.